Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 15th of 2026. Start off this week with retail sales, which had a bit of a disappointing print in the last reading. You can see here, December reading was basically flat after several months of some rather encouraging data. And again, 1 month does not a trend make, but it is something worth noting. Here we look at the categories of spending. Building materials and sporting goods were particularly good. Gasoline stations were okay. And then down here in some of the other key components, we had some actually erosion in electronics, appliances, clothing, furniture, home furnishings were all in the negative. And again, this data can be rather noisy, but as we do know that retail sales and consumption overall has been a real bellwether for this economy here over the last couple of years at a time where at points we felt like we were at risk of a recession. But retail sales being as robust as it has been has certainly kept us out of that. So demand remains relatively strong, but again, we had a rather disappointing month that was below the expectation of the market. Here we have retail sales versus the pre-pandemic trend. Again, a well-established trend line, albeit with noise around the pandemic and the shutdown itself. But you can still see here that at least from a trend line basis, we're very much flat, and we've now fallen consistently below that trend line, that pre-pandemic trend line here for a number of quarters now. Now we'll switch over to Consumer Price Index, something else that we're getting more recent data on. Overall was up 2.4% year over year on an annualized basis. The core inflation year over year was 2.5%. You can still see, as we've discussed quite a bit, the downward slope of inflation, but the fact that it remains somewhat sticky, kind of in the mid 2% range. And so, again, just to remind you, core CPI excludes food and energy, which, as we know, can be quite volatile. You can see here year over year changes in ground beef. We've talked about this. This is a big, home health care. Interestingly, watches. This came out of the Wall Street Journal, so some interesting topics here. But obviously, hospital care, laundry services, and this is kind of a wide swath of things here. Public mass transit even experienced above trend inflation, this being the overall level of inflation year over year. Gasoline prices we know are down because crude prices are off on a year over year basis. And we've talked a little bit about used cars and trucks, which were up quite a bit in the aftermath of the pandemic when we had supply chain issues and we had kind of a shortage. And so that's kind of in a reversal mode. But these are the components that contribute to this K-shaped economy, where those without robust incomes are feeling the cost of items like ground beef at the supermarket much more expensive than they were a year ago. And you can see here, I mean, this is 17% up year over year, which is very robust. So while we have core inflation, which is trending down, maybe a little sticky in the mid twos here, there are components that are clearly causing pain amongst a percent of our population. The Atlanta Fed produces the GDP now. This is something I've introduced to you and have highlighted many, many times. It's a very good indicator of where the anticipated GDP is going to fall. So we will get another, and actually the final reading here, or the second reading this month, but of the fourth quarter GDP and where it's ultimately going to wind up. Right now, it's sitting about 3.7%, and you can see, in all of these cases, I mean, it's data dependent. So as the data comes in, these estimates move around quite a bit. And for a while, we were up in the 5% range and very optimistic, and it almost, I felt like at the time, almost too optimistic for fourth quarter annualized economic growth. But right now, we're setting about 3.7, which, again, looking at over the last few quarters and where we've ended up is actually would be a sequential increase for 2 consecutive quarters on the annualized growth rate. So puts and takes here, we have delinquencies amongst credit cards. Now we do know that credit card usage has rolled over a little bit. We've shown you some of those charts in recent memory, but delinquencies are certainly spiking. So this is something that we pay attention to. And these are delinquencies with credit card rates that have gone up, and we talked about that too. Average credit card charge interest rates are anywhere between 18 and 22%, if not higher, depending on your credit level. But that is causing some stress. So clearly, while their economy is hitting on a lot of very quality cylinders, when you look at delinquencies and the health of the consumer, this is something that's worth paying attention to. We'll talk about the PE ratio. We'll switch and talk about the markets for a second here. We've got the U.S. price to earnings ratio being higher still than the rest of the world. We see that both in the world ex-United States valuations are moving higher, certainly over the near term, where we've seen some outperformance from international markets, which is, I think, very, very, very healthy because we did have this very wide differential. But again, we've had growth in the U.S., maybe a little bit of a retrenchment here in technology stocks over the last month. But nevertheless, international stocks have continued to rise and also expanded in terms of their multiples of earnings. Here we have profit margins. What's interesting here is that you've got the Magnificent Seven. So this is really the proxy for the tech sector, if you will. And these are the largest companies, of course, and so it's not all encompassing, but I think it's informative from the standpoint that these margins have continued to move higher. These are firms that have tremendous scale and a tremendous amount of non-fixed overhead, although they're spending billions and literally hundreds of billions on infrastructure. But you have a lot of margin expansion here, whereas when you look at the rest of the market, we've had some expansion, but this is from Apollo and Torsten Slok, and he says no signs of profit margins. I would push back on that a little bit in the sense that it looks like you're having a little bit of improvement here, but I think the point is that it's just not much. So when we talk about margin expansions and how I feel like they just seem unsustainable, it's most of that's coming from the tech sector, and we are to maybe modify this headline a little bit. We're just getting very, very, very modest expansion in margins from the non-tech sector. So AI, obviously, big buzzword. That was kind of the topic du jour in 2025, and I think it will continue to be in 2026. I had a chance to listen to the former president of the Dallas Federal Reserve Bank discuss this very point. And what's interesting, we're just talking about margins. He believes that the benefits from AI will come in kind of a 3 to 4 year window, but oddly enough, companies are going to have to be spending to get to a point where they can transition and take full adoption, maybe a higher level of intensity with the use of AI. And so actually it could be hurtful to margins in the near term before you get that productivity boost. But having said that, earnings estimates here for the Magnificent Seven, are really not expanding. And again, this, when you look at earnings estimates, it is a function and a byproduct of margins, of operating margins. And we just looked at that. So we do know that operating margins for the tech sector and for the Magnificent Seven will remain high. When you look at the rest of the stocks in the S&P 500, you're really not getting any change or any bump from AI right here. And this would be the overall S&P 500. So that obviously encompasses this, which is heavily influenced by that. But when you look at the rest of the S&P 500, really not much of a change in earnings estimates as we look into 2026. Here we have an economic surprise index. I thought this is a very insightful chart because we have the Citigroup Economic Surprise Index for the United States, and that's in this kind of this gold line here. And you can see that that's overlaid with the 10-year yield, which you know, not too surprisingly when you think about it, but on its face, it really did capture my attention here that there's a pretty reasonable amount of correlation here. There's points where you do get deviation, but there's a pretty decent relationship here. It got really, really noisy, uh, here in 2025. But having said that, we're basically at a point where we're having more positive economic surprises. The 10-year has not caught up, and so from Apollo's point of view, that you're going to get that 10-year moving higher in response to these positive economic surprises. Hence, the headline points to higher long rates ahead. And I think if you look at it purely from a yield curve standpoint, having more steepness in the yield curve is helpful, and it helps to it tends to correlate better with a well-functioning economy. However, that does imply some potential headwinds for long-term treasuries in terms of yields moving higher and values and prices moving lower. Now we've got a couple of sectors here. We've got consumer discretionary, and I thought this is very interesting because this is the really the essential dynamic that's going on right now. You've got discretionary, which is moving lower, and you see the relative strength index here is actually pretty poor. I mean, it's almost, this is basically at an oversold level, and you can see, like, if we overlaid this with 50-day moving averages, I mean, we would have clearly busted through that. However, on the other side, you got staples, and so this is a little bit of the growth versus value issue that we're seeing right now, where value had long underperformed growth, but had recently kind of taken the mantle, so to speak. And you see that consumer staples as a sector have really moved higher in a pretty short period of time, as we've seen a bit of this rotation from growth to value. Talk about operating profits. You have to talk about free cash flow. Any, I think, astute, investment manager who has a chartered financial analyst designation will tell you cash flow is king. And where you can, there are things you can do to obfuscate earnings. You can't, change cash. It is what it is. And this is free cash flow. And an indicator of what big companies are doing with their free cash. And so this in this chart is identifying share buybacks and debt paydown, which you think about, those are two very active uses of cash, and have been honestly for a number of years for large companies. Now that's taken a back seat. And you can see at this, as this headline would suggest, they're doing more capital spending. So they're doing more company reinvestments. That's plant, infrastructure, very large capital items, and you can see that has changed somewhat. And so my takeaway from this is, one, you do have the influence of all of these companies, right? So this is, we do know that that the large tech companies are doing a lot of reinvestment, which ironically is one of the primary criticisms and one of the reasons why these companies have sold off in the last month. And I'd say I probably would take Apple out of that basket, but the rest of the hyperscalers here, minus Tesla, have, the criticism is that they're spending too much and that these projections are a bit unrealistic. And so, what was just this blind optimism perhaps a year and a half ago has turned into kind of a mutated skepticism of sorts. But obviously this is very positive from a money velocity standpoint. We've got a lot of the difference between these two things represents a lot of money in motion in our economy, multiplying within that economy with all the various vendors and helping our economy out. Now we talk about turnover within the equity market. This is daily equity market turnover. So we've seen a lot more volume. in our markets. And as we'll see here in just a second, we've got retail interest, retail investors that are looking to take advantage of the weakness and helping to drive a little bit of this. Of course, this data series goes back to about 2019, if you will, and so we've had a pretty strong year in 2025 in terms of increased volume in the markets, and that's definitely played out this year to date. Here we have the Institutional Investor Exposure Index, and you can see here that we've taken a little bit of the momentum off the table. You see the line of best fit, is like kind of like right here. We've had some aberrations. This is, probably late spring, the tariff tantrum, if you will, April. I'd say it's actually more early spring, but April with the tariff announcements. And then we fought back and we had some pretty high optimism here on the institutional level. Not to say that 80% is weak, it's just basically off its peaks here. Now, the other thing on the individual investor side, by virtue of this AAII index, is that bearish sentiment has picked up where it had been going down for a few months, and then you see the bullish side has gone down a little bit. So you see a little bit of kind of netting out here of overall individual investor sentiment, which again, not surprising. Oftentimes this is kind of a lagging indicator. You get movements in the market, and then sentiment changes as a result of that. Here we have risk appetite. You can see that has gone down, but overall risk appetite is certainly above the break-even line here. So people, you do see money flows that are still positive overall net. They're just, as we mentioned earlier, rotating between growth and value and rotating between large and small, and then obviously rotating into international, which had a great year last year. So money flows still remain conducive. Now here on this side, we look at expected equity market performance over the next 30 days. Maybe a little bit of volatility here. That optimism is certainly kind of peeled off. But again, this data is extremely noisy, even though this time series goes back several years, but just goes to show you that the sentiment and, just to call it sentiment, can change rather quickly in these data series. We have the earnings picture, and I thought this was material. I've shown you kind of something that looks a lot like this in recent weeks, but when we look at the difference between the fourth quarter of last year and what we anticipate this year, you can see here that a lot of these sectors that didn't participate in earnings growth last year to a great degree, like consumer discretionary, expected to have a huge turnaround. And that's very interesting because we just looked at the consumer discretionary sector is now underperforming staples, which are also expected to have large earnings increases, as are energy. You look at real estate, certainly look at healthcare, where we've had, and we'll look at this in a second here, that is that basically the bulk of the job growth that we've seen here over the last couple of years. And then, materials and utilities. Again, these are sectors that are expected to post significant increases in earnings relative to a year ago, where we have communication services and technology that are expected to kind of hold in there, but we have a much broader representation of earnings growth, which again, as I've said before, I think this is extremely healthy for a stock market. And when you have this kind of growth, it gives you a little bit more comfort in the higher multiples, even though I can't say that I'm extremely ecstatic at higher multiples, but they have come in. These multiples have decreased a little bit, particularly with the technology multiples. But again, a broadening of earnings growth is, I think, very positive for our overall market. Here we have retail purchases. You can see here that we've had kind of a resurgence here. This is data that goes back to last week. You can see equity trading volume, so not too surprising, just looking at this data. and you see retail is up a little bit. You see institutional. We saw the name index kind of roll over a little bit, and oddly enough, we saw the individual investor kind of like their bearish sentiment pick up. But having said that, we do see trading volume picking up on the retail side. And again, this is all trading volume, so these could be buys and sales. But you see that overall activity from the institutional side is paring down at the same time that retail is picking up a little bit. Now, these represent purchases, and again, a little bit noisy, but it just goes to show you that it's good to look at a lot of different indicators because some will paint a less conducive picture than others, and taking them in composite, you could see that there's, I think this is probably evidence of a bit of a sector rotation here from a retail investor perspective. Interest payments to foreign holders. Now we do know that interest on the national debt is certainly picking up over $1 trillion now, and that's more than we spend on national defense. So that trend is only going to continue. So we've got basically a little less than $300 billion of interest payments are going to foreign holders, and you can see here this is a function of rising interest rates. You go back to 1970, that this is really kind of a geometric curve. It's not even a linear increase. I mean, and basically the change over the last 5 years has been extraordinary. Here we have job growth since January of 2024. As I said earlier, kind of like burying the lead a little bit, that we've had healthcare job growth, which has actually been tremendous. And what's really interesting is that if going back to the beginning of 2024, so let's call it 2 years now, that outside of healthcare, other segments of the market have actually witnessed a negative rate of increase in job growth. So healthcare has really been the driver here. Here's some more charts on job growth, and as we look at 2025, net gain of less than 200,000 jobs was the weakest that we've seen since 2003. And so this is a kind of a byproduct of kind of a gradually weakening labor market that's not in the aggregate weak, but it is weakening. And you can see private employment change, maybe picked up a little bit, but again, it's still subdued to relative to what we saw in prior years. And so this whole period, I'll call it like from in this chart 2023, but if you go here in 2021, you could see job growth has been decelerating ever since, just as you would infer from this chart as well. Here we have average hourly earnings. This is important to us because you've got basically about year over year 3.7%. We know inflation is below that. So in a positive sense, you have real wages that are still positive, which is good. Obviously you want to keep up with inflation. And so we are doing that now, but wages have remained relatively sticky, even if they have come down modestly over the last year and a half. And so obviously something that we still want to continue to monitor here with regard to its input into overall inflation. National Federation of Independent Business Optimism Index does remain somewhat strong at these levels. Now we dig down into some of the details within this particular survey. We see plans to increase employment. Oddly enough, a little bit higher. Now, we just talked a little bit about the weakening in the labor market, but again, plans to increase employment don't necessarily translate directly into increased employment, right? These are just plans, and plans can change, and we do know that they can change rather quickly. But payroll growth, as we see here in the blue, is definitely on the decline. So I might call this a green shoot, but obviously we got to see it kind of manifest into real payroll growth before we get real excited about it. Here we have compensation plans and wage growth, which we know have been in some deceleration. We just looked at that wage tracker, if you will, and so wages are perking up a little bit. This does raise some eyebrows for me because wages are a material input into core CPI. And as I've said, these are kind of the stickier components of inflation. And so, we might have some subtle inflation pressure on the margin here coming from wages at the small business sector that we want to pay attention to because obviously, wage growth and overall inflation are going to be really important to the analysis of that tug of war between the Fed and new chair Kevin Warsh with a easing bias, with a rate lowering bias, kind of bumping up against the potential for wage pressure holding inflation higher than it should be. Here we have employment cost index, and this includes benefits as well. So again, deceleration here. So, if you just looked at this chart and you're on the Federal Reserve Open Market Committee making decisions on interest rates, you would look at this and say, all right, well, I've got cover to lower interest rates. But again, taking into context the chart that I just showed you, that at least small businesses seem to have some wage growth and maybe some competitive pressures in the market, trying to hire talent, having to pay a little bit more, belies this a little bit. But again, that's why I said earlier, it's important to look at, the official U.S. The ECI, the Employment Cost Index, and also look at these surveys from the National Federation of Independent Business and Indeed and all these other different sources and put together the mosaic of what we feel is actually going on. In a positive way, look at household debt as a percent of GDP. And even though we do see, debt increasing overall, and we talked about credit card delinquencies rising, when you talk about household debt as a percent of GDP and it's moving down to 60%, and, it's obviously we had a lot of profligacy in our mortgage market back in the, around the, certainly before the global financial crisis, that this whole period has passed, and what we're seeing is this rather consistent decline, absent and notwithstanding the coronavirus and COVID-19, that continues to go down again. So when you look at households on net, they're doing better. But again, we cannot ignore what's going on in the credit markets. You can see student loan delinquencies have gone nuts. And even on the serious delinquencies here, now we see these different categories. You've got credit card loans, which we were just talking about. Again, the rate of growth and the aggregate number. We do see the percent of loans remain steady, but we see the balances move higher on those overall delinquencies. That's what we were looking at earlier. You see these other categories, whether it's mortgages, auto loans. Interestingly enough, we saw kind of a peaking in new overall delinquencies here, and you saw a flattening in mortgage delinquencies. So again, it's a mixed bag here. Student loans certainly aren't helping. We had a moratorium on repayment following the pandemic, and when that was lifted, that's what led to a lot of these delinquencies. Home ownership affordability gap. This is something we've talked about for a while. This goes back to 2021, 2022, when we saw that really material inflection point that has really created a big air pocket here. And this is the actual median household income. And this is basically that level where annual home ownership costs, as this indicates, does not exceed 30% of annual income. And so qualified income, there's a big gap between actual income, and you can see why home ownership is such an issue right now. Here we have existing home sales, which honestly had its worst month in quite a while. This is units sold were down, a very noticeable downtick here. and in aggregate, sales growth rate was negative to the tune of about 4.4%. That is on an annualized basis. For the month, they were down almost 8.5%. Very, very material change here in the market. We've got rental inflation, which is, the whole notion of rent versus buy, and we talk a lot about rents coming down. Now we do see this is a measure of rent inflation in several different categories. So, right, you've got not only the owner's equivalent rent, which is the official figure that's embedded in the core CPI. You can see that rent is relatively stable here, about 2%. This is rental inflation. But in these other measures, when you talk about Zillow or Cotality, which is less often cited, you can see that these are all in kind of a deceleration mode. And again, this is a national figure. This is from a PIMCO research piece, and doesn't represent all markets. And I do know, like markets like Austin, for example, we saw aggregate rents down around like 3.5% to 4% in the latest reading. And so this is very, you can have very strong geographical fluctuations, but again, overall rents as a percent or as a component into core inflation is just flat at the moment. So what we're looking at here is the cumulative change in rents, and I think it's important to understand the relationship between like changes in rates of growth and aggregate price levels. And so the key takeaway here is that while we can celebrate lower overall rent inflation, it's important to realize that we did have hyperinflation, or we didn't, hyperinflation is too strong, but we did have accelerated inflation for a number of years following the pandemic and rents. And so even though we're declining at a lower rate, we're still increasing, but we're increasing off a higher base. And so when we talk about affordability and aggregate levels and where there's a disconnect between household income and kind of the income that you would need to have things be much more affordable, this is why and this is just on the rental side, it's not on the home price side, but it still paints the same picture that we're coming off of a higher base. On this slide, we have oil prices. Again, we've had some geopolitical tensions, which I won't necessarily go into, but notwithstanding, they have had an impact on oil prices, and as a result, on gasoline futures. And we do know, like from a storage standpoint, we've been somewhat tight on gasoline, and we're getting a little bit closer to. Amazingly enough, we're halfway through February, and we're kind of in that shoulder season, or getting close to that, following winter and before summer. But if we remain tight on inventories with higher crude prices as a result of the geopolitical issues going on, that could lead to higher gasoline prices for the peak driving season. We've got a couple of comments on gold before we have a couple of items of personal interest before we close out here today. We've got the inverted U.S. 10-year real rate in the blue line and green line. We've got gold, a pretty tight relationship. The time series goes back to about 2006 here, and very interesting disconnect. So obviously gold price has been very strong. And that relationship with rates has completely broke down, and we've seen a huge move in gold, and there are reasons for that. And we'll got a couple of slides which might illuminate that. But you got rates moving down, but gold prices moving higher. So not something you typically see, but clearly been one of the many anomalies of the markets over the last couple of years. We have a chart that shows you what China is doing, and we talked a little bit about this, and this is, we see this coming out of some other markets as well. But you've got China's U.S. Treasury holdings here in the red. That continues to drop, and down by a meaningful percentage. And what's really interesting is, they not too surprisingly are diversifying away from the dollar as a percent of total reserves. Again, no one should be shocked by that. But I think the real takeaway here is you've got central banks, and China is just one of the many that are exhibiting a huge increase in gold purchases on the open market. Last week, we showed you kind of a source of where gold is, and obviously there's a lot of gold that's resident in jewelry, and a relatively finite pie or share of the total supply of gold in the world is held in coin and bullion. But you have more of that being purchased by central banks, and in this case, China in particular, and that's had a very meaningful impact on the price of gold, and it helps to contribute to that disparity that we saw in that last chart. Here we have another chart which kind of emphasizes my point on gold reserves. And so you've got U.S. Treasuries here in the red. You can see that this is overall central banks. So what we looked at just now was China. This represents kind of a synopsis of some of the larger central bank reserves. And you can see treasuries going down at the same time, gold moving higher. So this is just emphasizing my point on that last chart about the disintermediation out of treasuries and into gold. Foreign direct investment in China, another interesting chart. At some point we'll do a deeper dive into China, but you can see that outflows from from FDI have accelerated at the same time that you've got inflows which are decelerating in China. And so, this is obviously of concern to China, but it's interesting from a fund flows, because things leave certain markets. Investment leaves markets generally not to go sit on the sidelines, but to go find other higher and better uses of that. And so that's clearly happening in China right now, where you're seeing a little bit of trepidation and capital flight at the same time. Last chart here, we have a survey from Gallup that I thought was really interesting. I've never really paid much attention to this survey before, but this is how people, as a survey of whether people feel like they are thriving or not in their lives, not anything specifically related to finance, but just are you thriving in your life? And very much a soft sentiment indicator, and you can see it's noisy, but my takeaway here is just that this is this is a pretty low number, right? And it's like you got to go back to COVID, and you got to go back to 2020, and then prior to that you got to go back to the global financial crisis to see numbers that are really this terrible out there. So again, more fuel to the notion that you have this divergence in the economy where you have a lot of people that are well compensated, higher overall household income, that feel frankly pretty good about things, and then you have the rest of the folks out there that are seeing higher prices at the pump. They're seeing higher grocery bills. They're seeing higher even labor costs for auto maintenance, and they feel generally less well about things. That's all the charts that we have this week. I hope you've enjoyed it. Have a great week. We'll talk to you again soon.